Good morning and welcome to our latest webinar. Thank you very much for being with us today. My name is Sonia Fry and I'm the Head of Marketing here at Ludlow Thompson, and I will be hosting today's webinar. I hope you're keeping safe and well and you've had a brilliant morning so far. Today's focus is the London buy-to-let market, covering how it has fared over the winter period and our 5 reasons for optimism. This follows the release of our latest buy-to-let review, which we publish every quarter. So this was reviewing Q4 of 2020. And if you haven't read that already, you can find it on our website. I have Stephen Ludlow here with me today. Hi, Stephen.
Hi.
Stephen is our chairman here at Ludlow Thompson, but is also a buy-to-let investor himself and a well-known market commentator. He will be taking us through his insights into the London rental market and giving us some predictions for 2021. And as he goes through the presentation we have for you today, I will be asking him some questions along the way. And as usual, if you have any questions, please use the Q&A function on your screen to send these over. We want this to be as interactive as possible, so please don't be shy, do use that functionality. And at the end, we will choose a few questions to answer live. So without further ado, let's get started. Stephen, how are you this morning?
Very well, thank you, Sonia. And indeed, good morning, everybody. And I hope you and your families and all of your colleagues are safe and well.
So Stephen, 2020, what a year and what an end to a year with another lockdown and restrictions still in place when I think a lot of us were hoping for more progress. However, we might be seeing a light at the end of the tunnel finally with the latest government announcement on Monday, along with the success of the vaccine rollout. So it looks like a positive start to this year and hopefully good news to come.
Yes, indeed. And although we're still obviously operating under COVID-19 restrictions quite correctly, the property market itself has been as lively as ever.
Yeah, so let's kick off with our first reason for optimism, which is the property market growth we saw in 2020. I can see some positive numbers on the sales market there. Can you explain the background to this and how this impacts on the buy-to-let market?
Yes, indeed. Let's take a moment to look at the graphics. The London sales market has produced some really credible numbers this year, with house prices in the capital increasing 2.9% year on year. And it's worth noting at this point that in relation to other economic corrections followed by recessions, for example, the credit crunch, this is the first time that the property market has diversified away from the performance of the economy, which generally has seen a fall of 11% in GDP in 2020. So then what's caused this? Well, there's no doubt that it's been particularly driven by the stamp duty holiday for purchases up to £500,000, which I have to add at this point, unusually for the government, that's tended to regulate buy-to-let investment somewhat over recent years. This relief also benefited buy-to-let purchasers, albeit still having to pay the 3% additional tax relating to buy-to-let. Now, the timing of this was originally through to the 31st of March, but according to the media speculation, that the Times ran a story on Tuesday evening suggesting that this relief will be tapered out now until the 30th of June. So the reason behind this decision and the knock-on effect is a subject matter that I'm going to pick up on specifically later on. It should be noted, however, that price rises have had as much to do with the availability of record low interest rates and the perpetual imbalance between supply and demand for London property, a factor that market data suggests is likely to continue beyond the stamp duty deadline, whether that be March 31st or the June deadline that may well be set. So you may ask, well, why are capital prices an important factor for the buy-to-let market and the investors who joined us this morning? Well, it's reflected in the property investment's total return. And again, the graphic picks this up. And how do we get to our total return? Well, it's a net combination of net rental income. So that's after all fees, expensive repairs, voids, etc. have been offset, and the capital appreciation. And it's calculated on an annual basis. And it's a figure that for last year sat at 5.91% for the year ending December 2020. And that was up 3.4% from 2.5% in 2019. So quite an increase. And really it demonstrates what a balanced investment product London buy-to-let is, as in a period where rents have been tempered somewhat, capital prices have underpinned asset values, which sits in contrast to, say, another recognised economic barometer, which is the FTSE 100, the stock exchange, where total returns, which is made up of dividends received and equity values, the price of shares, that fell by 11.5% in 2020.
Some great insight there, Stephen. Thank you so much. You mentioned London rents falling in 2020. Can you just expand on that and maybe give us some more insights?
Yes, of course. Let's look again at another graphic that we've prepared. Overall, Ludlow Thompson estimate that London rents have dropped 8.5% across the board. So that's across the whole of London, which, with the population of London falling by 700,000 people in 2020, perhaps that shouldn't be a surprise, as population numbers tend to act as a barometer for residential rents. What do I mean by that? Well, when the population goes up, the supply and demand imbalance, which I've talked about earlier in relation to the sales market, also exists on the letting market. So the supply and demand imbalance dictates that rents increase. So when the population falls, the converse is surely true. Well, possibly yes, but in this example, on this occasion, so this COVID-19 situation, it's somewhat represents a skewed picture, as the majority of moves in London, so that's people moving in London, came from people already living in London. So the majority of moves in London came from people living in London. So that suggests that the exodus of people, the 700,000 people who've left, have perhaps left just for now. And further, the figure is tilted by the fact that prime central London rents, so if we look in the middle of the map, prime central London rents fell by 14%. And the reason behind that is that corporate, Airbnb and overseas postgraduate rental markets fell away fastest and furthest. Whereas, as illustrated by the graphic, this clearly illustrates that as one moves further out, so moves from the lighter to the darker colours, rental levels in inner London's suburbs fell by a much less significant amount, perhaps 4 to 5%. Indeed, take Ludlow Thompson's markets. Now, the central ones, the city market, where we're exposed to the Square Mile and Canary Wharf employment centres, these areas will host 600,000 employees or so. Well, in these locations, we've seen the greatest fall in residential rents, perhaps as much as 10%. This contrasts with our locations further out. And interestingly, I've looked at those near the London's major hospitals specifically. So Guy's and St Thomas's at Kennington Oval, King's at East Dulwich, and St George's in Tooting, where we saw comparable rents perform significantly better. Now, not so much because I believe that people wanted immediate access to emergency services, but because the supply chain and infrastructure that these significant hubs, these hospital hubs require, remained open and indeed very well supplied in terms of the local restaurants would see it worthwhile offering takeaway services. The supermarkets would be fully stocked and open extended hours. So these factors combined meant that people were attracted to the area, which when added to an emerging preference for outdoor space and scope for home working at affordable rents, it certainly bolstered the appeal of such locations over central London locations.
Thanks, Stephen. But so really a difficult time for the London rental market overall, though.
A trying time for London rental market, on the one hand, yes, but actually in terms of its resilience and tolerance, when we drill down to the granular stats, as I've shown on the graphic. So if you look at the other side of the graphic, away from the rental falls, we see that the granular stats provide some reassuring figures. The rent arrears, for example, sat at just 1.8% of Ludlow Thompson's portfolio. So to put that in perspective, that's an increase of just under 1% from 2019. And who would have thought when going into lockdown that we'd be recording those sort of statistics, and indeed those statistics were sustainable. But one predominant reason for that is that London's wide range of creative and financial industries were equipped to adapt to the modern hybrid way of working, i.e. people working from home, but still working to capacity. And that meant that London boroughs maintained amongst the lowest percentage of UK employees on furlough. For example, the borough of Wandsworth, we talked about that in relation to St George's, was in the top 5 of the lowest percentage of furlough workers in the country. So actually London had a very resilient employment market, even though people weren't necessarily working from home. So I said that rent arrears performed very well in terms of the position in the market, and also voids. Voids moved out from just 12 days to 17 days on the Ludlow Thompson managed reletting portfolio. However, one trend we have noticed, and we've referenced is that the average tenancy length fell from 23 months to 28 months. So that was a change over the prior year.
Okay, so the current situation seems quite balanced then. So with that in mind, what's your forecast even for the rest of 2021?
Well, I'm optimistic for 2021 and I'm optimistic for beyond. And with that in mind, I've produced a state of the nation graphic to support my argument. So look, the first thing to focus on is the jabs. I'm sure some people on the call today will have been invited in for their initial jabs, which is great news. So the vaccine rollout predicted to having reached 32 million citizens by May. And in fairness, on that KPI, we seem to be on target every day. It's a game changer with the knock-on effect of facilitating what the Prime Minister describes as a roadmap for opening up society and, of course, with it, the economy, to the extent that the Bank of England are expecting a reversal of 2020's 11% fall in GDP, which we commented on earlier, and expect that to grow to a positive figure of 5.5% by the end of 2021, with London as ever central to the economic growth. Now, London University, you'll see here from the graphic, London University, which boasts both Imperial College, obviously leading university in terms of the research behind the vaccine, and UCL. These both sit amongst the top 10 universities in the world in terms of world rankings, so sit in the top 10. But indeed, London, the University of London hosts 120,000 students who in 2020 will have received predominantly online lectures, whereas by the autumn of 2021, we expect them to return to a more familiar chalk and talk method of teaching, and a greater number then will be living, renting, and of course socialising in London to a greater extent than they were in 2020. Furthermore, the confirmation for trade deal of the EU, so if you look there, we've got the EU logo, on the 31st of December 2020, so it ran very close to the line. It seems to have been understandably overshadowed by media commentary on COVID-19 updates, and in particular remembering what I said earlier about population growth driving rental growth. What's important is that the arrangements around the movement of people have been clarified within the agreement. And I thought it'd be worth just taking us through a brief summary because of the importance of the population of London growing and a corresponding growth in rents. So looking at the bare terms of this part of the agreement, and the agreement's about 1,200 pages overall, so you'll be relieved we're not going through that this morning. There's an ongoing review of the shortage. There's an ongoing review of the shortage of occupation lists. So what does that mean? Well, that means that where we particularly have a short supply of labour in particular areas. So if you're asking me to guess how that may play out, perhaps nurses and carers. There'll be relaxed freedom of movement in terms of people coming not only from Europe, of course, remember, this is a deal in relation to overseas freedom of movement as well. There's also been the confirmation of settled status. So that means that for people who were here over the last 5 years and before the 31st December have the right to apply for settled status by the end of June, as indeed those who hadn't applied, they could apply for pre-settled status providing they met that criteria. So that's, again, you had to be in the UK, and in our case in London, on the 31st December 2020, and you need to get your application in for June. Now, UK employers, and I have to say, as a UK employer, I've looked at this, you can quite readily become sponsors of overseas applicants. And the sort of requirement for an overseas applicant is the equivalent of A-level education or Tier 4 level on the ICT qualification, as well as those who I said earlier who've been identified on the shortage of occupation list, i.e. workers we need to keep the economy going. There's also a Turing scheme for students, so international students, to participate in two-way exchange schemes. So that's something that previously was called the Erasmus scheme. That's still on the agenda. So in terms of rebuilding the population and therefore rental growth rebuilding, you can see how I'm optimistic about this. And indeed, in surmising, say that the terms of this element of the deal of the EU present parameters that the London rental market can work well within, and I indeed, because of the rise in population and a forecast rise in rents, will benefit from. Taken then together, this slide and all its positive news, the news on the vaccine, the deal with Europe, the opening up of London's commercial and academic centres, and a forecast increase in GDP of 5.5%, well, they all bode well for London buy-to-let in the Q3 and Q4, the latter part of 2021, and indeed very much so beyond.
Fantastic. Let's keep our fingers crossed that we can start to see some normality resume in the coming months then. And like you said, Stephen, the opening up of society and the positive impacts that that then has on economy. You've put a lot of emphasis on the impact of the government stamp duty holiday and the growth of London house prices resulting from that initiative. So are you not concerned that as we approach what is now seemingly a June deadline, that the market is sitting on a bit of a cliff edge?
Well, you know, when you're predicting markets, Sonia, you've put me on the spot there, because predicting markets is always difficult. But again, let's look at the background and statistics that will support my suggestion that in fact I think capital prices will continue to grow. So take your point that whether the stamp duty holiday has encouraged demand, that they call it cliff edge demand, because of course when we get to the cliff edge, that demand suddenly falls away. So has the stamp duty holiday, is there a danger it creates cliff edge demand? Well, the early indicators are that there's such an imbalance between supply and demand that will prevail in underpinning prices. And let's look at probably the two most recognised property websites in the UK. Let's look at Rightmove and Zoopla. Rightmove recorded a 45% increase in site visits in the first week of February 2021 over the same week in 2020. So from the first week in February 2021 up 40% over the equivalent week in 2020. And in January, Zoopla recorded a 40% increase in applicant registrations on its site versus just a 3.6% increase in vendor listings. So they really show the sort of imbalance between supply and demand. Now, let's say that those people, or let's agree, I feel, that those people who were looking in January and February, they knew they had no chance of beating the March the 31st deadline. So as is suggested, there's going to be an extension to June, then certainly until that date, and I suggest thereafter, such demand will continue to drive the market. Furthermore, the Bank of England suggests that there are 100 billion of excess savings that have been built up by UK households during COVID-19, and that money is looking for a safe haven, and residential property presents just that opportunity, whether through direct purchases, buy-to-let, or through the bank of mum and dad supporting their children's purchases.
Thanks, Stephen. Sorry for putting you on the spot there a little bit. So are you suggesting then that the Chancellor sees the property market as a driver for economic recovery?
Well, that's quite correct, Sonia. The Chancellor and his advisors see the property market as what economists refer to as an accelerator for the economy. So let me expand on that point with this diagram. The effect of the concession is this: the average stamp duty saving equates to £15,000, and that's £15,000 in cash. What do I mean by that? I don't mean, sorry, forgive me, I don't mean cash. What I mean by that is it's earned income. So to get £15,000 in your hand, you've pretty much had to have paid tax and national insurance about 32% on top of that. So that 15,000 effectively in terms of additional spend to the person who saved it is probably worth nearer to the early 20,000. And as the illustration shows, you imagine throwing a pound coin in the middle of that, get my spiral, right? In the middle of that spiral, the multiplier effect of that pound gets cash working throughout the economy. So in the case of property, the additional spend on purchases for the home, so purchases, DIY purchases, purchases of kitchens and bathrooms, and then secondly, through creating employment, through engaging builders to undertake the installation of goods and renewal works to properties. All of this support the growth of the economy. And so when the Chancellor was looking at the decision about stamp duty, he wasn't just thinking about house prices or the value of house prices. He was thinking about how property can act as an accelerator to the wider economy, and about how to unrelease that £100 billion of pent-up savings we referred to earlier and get that going. So that's the economic argument behind it. And now perhaps you can see why stamp duty has become such a hot topic in terms of the media and in terms of the government's thinking. And indeed, obviously, we await next week's budget, which we will be commentating on soon after, and the implications of any property-related decisions that come from that.
Okay, thanks, Stephen. Let's take a look at the final of our 5 reasons for optimism. You provided some interesting stats on financing opportunities. Could you sort of elaborate a little bit more on that for me?
Yeah, what I find interesting about this in terms of the perception of buy-to-let as an investment class by banks and mortgage lenders is that this is one of the first times ever that I've pretty much seen buy-to-let mortgages and domestic mortgages, so homeowner purchase mortgages, be aligned in terms of the sort of interest rates and indeed the fixed interest rates that they offer over a period of time. And to reiterate the point I made right at the outset, these sit at historic lows. So in fact, what we're seeing is people perhaps re-gear property, re-gear existing buy-to-let investments to buy other buy-to-let investments. But even if that's not your strategy at the moment, what I would encourage you to do is to look at your current arrangements and think about locking into a fixed rate, low interest buy-to-let mortgage, one, while it's available at the same rate as the domestic market, and two, while it's available at such low rates. So why do I say that? Well, a word of caution here, really. The line graph that we've got running across the graphic is data that we received just last Friday from the investment banker Buffon at Latham. And it's interesting because it shows that global interest rates are already beginning to rise. You can see that global interest rates have creeped up to just the 1.15% in terms of that long-term then. So keep a watch out. There is a prediction that rates will remain static for some time, or indeed there's a prediction that they could fall into negative rates. However, I think what we're saying is that it's got to be that as the GDP picks up, the economy picks up, that inflation may pick up, and interest rates may pick up to temper that inflation. So that's a word of warning there, and something that keep an eye on it.
So just to finish off the presentation then, Stephen, are there any tips that you could leave us with today on how we could sort of address the current market?
Well, certainly, yes. I think the big tip was my final tip, and I would go further than that. I'd call it a call to action as what one should do. I think lock in now at an attractive fixed rate, and if the market takes a short period, the rental market takes a short period to realign, as I suggested, perhaps through Q3 and Q4 of this year, i.e. from sort of September, June, July, August, September onwards. Then I think very important, if you lock in on a fixed rate, and as the rental market takes a short period to align, you'll ride this out by committing on a long-term tenancy, market rents, That will give you visual cash flow, so you'll know what your rental income is for, say, the next 2 to 3 years. You'll know what your interest rates are for the next 2 to 3 years. And that model, that's one of our most proven recommendations and one of our proven models that delivers higher net returns.
Thank you very much, Stephen. Now, before we finish, I can see we've had a number of questions come through on the Q&A, so I'll choose them at random for you to answer, Stephen. But just so you know, if there are any questions that we don't get to, we'll come back to you directly after the webinar. So the first question here says, Stephen referenced earlier about comparisons between other forms of investment and buy-to-let. How then does he see buy-to-let competing with, say, equities or commercial property?
Great, it's a good question, and you know, but both are commendable investment vehicles. But in terms of shares and the FTSE 100, as I referred to it earlier, so the stock exchange, yes, it's got greater liquidity. You know, while this webinar is going on, we could all buy and sell a few £100 or £1,000, depending on our means of shares. So there's liquidity over buy-to-let. There's no doubt about that. But when has happened in 2020, some of the most established companies on the FTSE, recognised household names such as BP and Shell and the banks, either substantially reduced or indeed suspended dividend payments altogether. Well, that decision is made by the main board of those companies, or in the case of banks, the regulator. So you're no longer in control as perhaps you are in respect of the strategic destiny of your buy-to-let, where you could make some improvements to make the property more attractive for the market, or indeed reduce your rent, but that decision is in your hands. So that's what I would say about the comparison with the stock exchange. With commercial property, again, in terms of investment, a new lease to an established company, so a recognised company that we all know, that's a fine investment, but it takes time to identify and profile such a letting. And indeed, as commercial leases, as they have over the last 10 years or so, they've tended to shorten in terms of their lease lengths, whilst residential tenancies, as I suggested earlier, have started to extend. So it's not uncommon to have a 2 to 3 year residential let and only now a 5-year commercial let. So the flexibility of residential investment is becoming increasingly attractive. And furthermore, we should look back to the outset of lockdown 1. Back in June 2020, Lambert Smith Hampson, the recognised commercial agent, was suggesting that commercial rent arrears were trending at 25%. And this was due from corporate entities. So corporate entities who, of course, have corporate protection in terms of their relationship with the landlord. Whereas at that time, Ludlow Thompson's rent arrears shot out initially to 2.5% before falling to 1.8% in December, as I alluded to earlier. But very importantly, the liability was with the individual tenant, and in a lot of cases, they're UK homeowning guarantors.
Thank you, Stephen. So let's have a look then. The next question reads, Stephen spoke about corporate letting, Airbnb and student letting. I wonder if he feels these properties owned by investment funds will overrun buy-to-let landlords.
That's interesting. It is a new phenomenon, and it's correct to say that institutions are investing in what they call bed space. But in reality, they find it difficult to compete with the domestic market. We've seen that we've got a very good residential property market, both in London and the UK. And obviously, when the funds are buying, they're hoping to buy at a discount to make their investment work. So they're competing with a full-on domestic market. And they want to achieve rental returns and get to an investment return that's attractive to the market. They find it difficult to do it to the extent that the sort of well-versed term build to rent properties only hold 160,000 out of 4.5 million private rented home. So the market very much belongs to people on the webinar today, the buy-to-let investor, the individual buy-to-let investor. But I would just add, we can't take things for granted. The build to rent tends to be a new build, shiny new build product. So to remain competitive, individual landlords should continue to improve their offering through rigorous repair and renewal, as well as providing additional services such as cycle storage, broadband, and certainly 24/7 emergency repair services, which we provide through and to our managed landlords.
Thanks, Stephen. We're running a little bit over, but I'm going to squeeze in a couple more questions whilst we've got you. So we have another question here, and they're asking about basically the future of office working in London, and whether what you're saying about sort of workers returning to offices in the capital is in fact correct.
Yeah, very good point, and something we're all thinking about. This sort of, I used expression earlier, a hybrid between working at home and working in the office. You can see today that I'm in my office at home, so it's a good question, very current, very relevant. My own view of that is that some hard tasks, and this is perhaps going forwards even just a few weeks now, fortunately, some hard tasks such as say programming a spreadsheet might be better undertaken in a solitary working situation at home, but brainstorming, networking and collaboration often require the interaction that an office environment provides. So what I'm suggesting is going to emerge is a default switch between working from home, say 2 days a week, and then working in the office 3 days a week. And to do that over a long and sustained period of time, professional tenants will want to live within a cycle, run and or walk of the office, or indeed just a small commute. And the areas of London that offer attractive amenities, local leisure and retail are the ones that really buy-to-let matches, and indeed buy-to-let matches that investment case head on. So the new way of working, I think very much is buy-to-let suits that sort of juxtaposition between working from home as well as working in the office. And one further observation, of course, is that those employed in leisure, bar and entertainment services, who we know will be the last sectors to return to work, they're of course unable to work from home. So by definition, they'll be returning to work environments, and they'll want to be within a short commutable distance from their rented accommodation.
Thanks, Stephen. In relation to that, or in relation to working from home, we've had another quick question here that says, is it best practice to provide free broadband as part of the package, as part of the offering to tenants?
We've put a lot of coverage out on this recently, some newsletter articles on it, and I think that's probably, we're suggesting that as a recommendation now. I think traditionally it's been a cost that the tenant might pick up, but I see no danger in enhancing your product along those lines. The attractiveness of your buy-to-let investment. Indeed, the last webinar we did, which is up on the website, we talked about little changes you could make to repurpose your buy-to-let letting along those lines. And I certainly think that as I said earlier, cycle racks, broadband, perhaps, as I've got behind me, a flat screen TV, all of which come at quite a low price point in terms of being able to supplement the attractiveness of your proposal, your property for the market. They're things certainly in my buy-to-lets that I've taken on board and things that I look to deliver on.
Brilliant, thanks, Stephen. I'm conscious of time. I don't want to keep people for too much longer, but let's just go for one more question. So we've got a question here that says, can you clarify the new government legislation regarding leaseholders, ground rent charges, lease extensions to the 990 years? I need to extend my lease, but I'm concerned that this could be exceptionally expensive.
I think the best advice on that at the moment is is to get a surveyor, and there are particular kinds of surveyors who deal with what's called a marriage value valuation. So that values the difference between where your lease is at the moment and where your lease is for the future. And again, this is an example where I've been on both sides of relationships, both as a landlord extending leases and as a long leasehold tenant. So if by all means, if we will pick up your details and we'll be able to give you advice on where to go for that valuation. The second question that falls out of that, or observation, is quite often people set up, say 2 or 3 residents living in a flat, set up their own management company. That's fine if 1 or 2 of you are very hands-on and you're prepared to be able to commit to the time that involves, not only in terms of organising maintenance, but setting up a limited company and also doing audited accounts, etc. So just be careful on that. I think with the bigger blocks, if you have a good block manager, you have regular residence meetings, that's perhaps still the way to go. I think what the government is particularly looking at is what they don't, some of these leases have very aggressive step-ups in ground rent. So the ground rent moves not only at inflation, well beyond inflation. And what the government is looking to do is to taper that so that it's seen to be very fair. And I think we'll see in time ground rents will move up along lines with regular indices in terms of inflation, CPI or RPI. But by all means, on the valuation point, we'll do our very best to see if we can introduce you to somebody who'll be able to explain to you the mechanism behind that. So thank you very much.
Brilliant. Well, thank you very much, Stephen. I don't want to keep anybody too much longer, so I'm sorry if we haven't got to your question, but as I said, we will pick up on those individually after the webinar. Thanks everybody for joining us today and for interacting with us. We hope you enjoyed the webinar and found something of value to take away with you. Before we sign off, we'd love to hear your feedback on today's webinar and if there are any topics that you'd like us to cover in the future. So if you'd like to see Stephen maybe with a guest industry expert or somebody covering tips and advice, please let us know. Just email marketing@ludlowthompson.com and we look forward to hearing your ideas. Also, if you have any follow-up questions, you didn't put anything across in the Q&A, but after thinking for a little bit, you've got some questions, please don't hesitate to get in touch. We'd love to hear from you. Thank you all once again for joining us. Stay safe and have a lovely day.
Thank you all. Bye-bye.